Hi, everyone. This is Shoshana Zatz from CIBHS. Welcome to the Small County Fiscal TA webinar. This is the last of the series. We hope to be able to start them up again in the fall. Not quite sure about that, but look for information coming in the next couple of months. Mike is on the line and we'll be starting in just a minute. Just to let you know, we will be stopping every now and then for questions, so please type your questions in the question box and we'll get to them as soon as we can. This is being recorded and will be uploaded onto our website sometime next week. And hopefully you all are aware of the Fiscal Leadership Institute that will be taking place next week, Tuesday and Wednesday at the Sheraton. We're completely booked up. Hopefully you've gotten your registrations in, and we hope to see you there. So now I will turn it over to Mike.
Great, thank you, Shoshana. What we're going to cover this morning is just a brief update on a fiscal update based on the May revised budget, the budget proposal that was just released this month. There aren't a whole lot of changes from January, so it might be somewhat repetitive, but thought it was still worth going through and discussing this stuff with you guys. Again, looking at the major funding sources there, we'll go ahead and cover each one of those, and I'll stop after discussing each one to take any questions. So starting off with the 1991 realignment, again, going back to 1991, there were three sources of revenue: sales tax, vehicle license fees, and vehicle license fee collections that fund this revenue source. You're required to provide a maintenance of effort as part of participation in the 1991 realignment. And then in 11-12, so we go on for about 20 years, and then in 11-12, there was just this swap where the state basically took our mental health realignment and used it to fund what was formerly State General Fund CalWORKs dollars, and instead gave us this new revenue source with 2011 sales tax revenue. And what that really did was just guarantee us a minimum level of funding beginning in 12-13 and going forward. So that's really all you need to know there, is that we've got that guaranteed amount. In addition, once the revenues that go into our old 1991 account for sales tax and VLF, once those reach the 1.12 billion minimum, then we get growth. And so we've been receiving growth since basically 12-13. And that has not necessarily growth, but we've been receiving a base for sales tax and VLF because we received some growth in those early years. And then we also get 5% of the annual growth in the 2011 account because basically as a, I guess, kind of a bonus for allowing all this to happen. So we had that happen in 11-12. Realignment revenues are distributed to you folks on a monthly basis based on revenues that are received into the fund. But again, and you have four different accounts. You have the mental health account, mental health sales tax base, VLF base, and VLF collections. And so you see those four different distribution amounts and four different schedules on the State Controller's Office website. And the way that it works is you get up to your base amount in the prior year, and then any revenues received above those amounts go into growth accounts, one for sales tax and one for vehicle license fees. And historically, well, it's not historically, the way it's written is that sales tax growth, the first priority is any increase in social services caseload costs. And so the IHSS costs have increase quite a bit and often take up all, if not all, of the sales tax growth over the past quite a few years. But then VLF is more split equally between all of the programs. So then we go along with that for a couple years, and then more recently, the Department of Finance found that the Coordinated Care Initiative was not cost effective. And what that did was basically shift a bunch of IHSS costs onto the counties, which then basically increased social services caseload costs. And so the anticipation was it was going to go up about $600 million last year. And the legislation was written to modify 1991 realignment to fund this shortfall with a combination of state general fund monies and then redirecting 1991 realignment growth funds. And the legislation redirected VLF growth for 3 years, 100%, and that was through the current year, and then redirect also the 16-17 sales tax growth. It also redirected the VLF growth, 50% of the VLF growth for 1920 and 2021. And the two city programs were not impacted by this redirection. So basically what it means is that we have not seen any growth in our 1991 realignment accounts for the last 3 years. For 16-17 through current year through 18-19, we won't see any growth. However, and we talked about this back in January, the proposed 1920 budget will eliminate the redirection of growth funding. So if this is enacted, you would receive growth funds in October 2020 based on growth received in fiscal year 1920. And you will also then see an increase in your fiscal year 2021 base for both sales tax and VLF, depending on the growth. And so there's really two parts to this because, again, sales tax growth is distributed differently than the VLF growth. The VLF growth is the easiest to explain because it basically, the governor's proposal and the budget trailer bill language strikes out the provisions that redirect 50% of the VLF growth for fiscal years 1920 and 2021. So pretty straightforward. It will, the budget trailer bill language would modify the statute and eliminate that redirection of VLF. The sales tax is a little bit more complicated because, like I was saying, other than the redirection of the fiscal year 16-17 mental health sales tax growth, basically there hasn't been a redirection of mental health sales tax growth. What there's been is an increase in social services caseload costs that have absorbed all of the available growth funding. And so what the proposal is, it does a bunch of different things. It resets the IHSS base using historical state county cost ratios, rebases the maintenance of effort to only apply to county service costs, provides state general fund for administrative costs, goes through a bunch of these different things and restores a 7% across the board reduction in authorized IHS hours. So it slows down and reduces the amount of overall growth in the IHSS program and the social services caseload costs. But kind of the bottom line is that it's going to be funded with state general fund money. So they're taking state general fund monies, and rather than redirecting all this stuff, and rather than having to use all the sales tax growth to cover these costs, the proposal is to use additional state general fund monies to cover the increased caseload costs, thereby freeing up funds to be distributed to for our sales tax mental health realignment. So that's kind of the gist of it. VLF is straightforward, changes the statute. Sales tax is a little more complicated and is going to be dependent somewhat on the amount of state general funds that ultimately get appropriated to help mitigate the cost increases. And the other thing, even the proposal deals with the caseload cost increases, but it really doesn't address some of the core issues or one of the core problems that the Legislative Analyst's Office pointed out with 1991 realignment, which is that it's unclear whether the funding, especially on the mental health side, for 1991 realignment is covering the actual costs, because there's never been a correlation between costs for the programs that were realigned and the amount of funding you receive. So it's great. We'll start to get some growth, but it still doesn't address some of the fundamental issues. So with that, you can see what the projections are for 1991 realignment. Basically just looking at current year and budget year. Like I said, we have not seen any growth in the base. That little bit that you see there were for the two city programs from 16-17 through 18-19, City of Berkeley and Tri-Cities. And then the projection now is that in 1920, that we'll see 59.1 million in sales tax growth going to mental health and 26.8 million in vehicle license fees going to mental health. Vehicle license fees is basically based on about a 3% increase in the vehicle license fees. So they're hoping that vehicle license fees will go up about 3%, or the forecast is that it will go up about 3%. Sales tax, like I said, it's based on a forecast of sales tax going up about 5%, but it's also predicated on how much state general fund is used to help mitigate the additional social services caseload costs. So we'll have to wait and see on that. And again, both the 59 million and the 26 million, you wouldn't actually receive a distribution until we're, October-ish of 2020. So we're at least 4 months into fiscal year 2021. So it would be very speculative to try to include that in your 1920 budget and to try to encumber any revenues back to 1920. So we'll just have to kind of wait and see how that plays out. But it at least now looks good. The other part I didn't mention, so you have that one-time growth down there on the bottom. Those were actually revised downward a little bit. So the state's forecast for sales tax growth has gone down a little bit. But those seem at least a little bit more realistic given where sales tax is. The other thing is just again to point out on the 91 realignment, the state looks at the fiscal year as a September through August fiscal year on a cash basis in terms of when funds are distributed, and that your mental health line, the top line, you get on a monthly basis. But really, these two amounts, the sales tax base and the vehicle license fee base, those aren't paid until the CalWORKs MOE has been met. And so generally, you're not going to receive those until August. And the way revenues are currently, they're up a little bit. So it's highly likely the base will be met. And so you'll see those funds. So again, just in terms of the budget, current year, I think, like I said, I think we're going to hit the base on all these. And also just don't forget, what I'm showing on here are gross distributions. Your net may be a little bit less because they take any managed care offsets or state hospital offsets are deducted from your 1991 allocation. So I do think we will hit the base in the current year. And then, and that's also, you've already received the 5% from 17-18 that was distributed last October. And then, looking at budget year, nothing really different. I'd pretty much just keep it the same. I think the growth is even roughly the same, but this current year was, so roughly the same as current year. So I'd basically be looking at budgeting 1991 realignment comparable to what you have in the current year. The other thing on this, the nice thing about 91 realignment is the percentages for each individual county's allocation don't change. They basically stay the same from year to year. And so that makes it a little easier to project, as well as also this is your most flexible funding of your funding sources, of your allocations. So that's 91 realignment. Any questions on the 91 realignment?
There are a couple of questions.
Okay.
Where can we find information or direction on how to calculate the county MOE? Has this amount ever changed?
So, and we've sent it out before, and we can send it out again after this call. It did change. So there were original amounts back in 1991, but the revenues actually fell for that was going into Fund 91 realignment. So they adjusted the maintenance of effort down slightly. And I should say too, not all of you have a maintenance of effort. Some of the smaller counties, or the smallest counties, I want to say like 7 of you, don't have a maintenance of effort. But it's overall statewide. I want to say it's either 48 million or 64 million. I forget which. But we'll get that schedule out to you after the call this morning. And the other thing is nobody ever checks up whether you do that or not. So anyway.
Second question is, how is the mental health 5% of annual growth in 2011 realignment support services account received? Is that after other programs get their funds and only if there's growth left?
No, so the way it reads is that, so the support services account on the 2011 realignment includes both the behavioral health sub-account and the protective services sub-account. So once the base amounts for those 2 sub-accounts are met, everything else goes into the support services growth account. And the way that is divvied up is 5% goes to fund this, and then the balance is split between behavioral health and protective services. And I forget the exact ratios for those 2. I want to say it's like 50% goes to behavioral health sub-account and 45% goes to protective services sub-account. But generally, that comes across in one check, and it comes in generally October, November, and you should take it and put it into your 1991 account and consider it as if it was 1991 mental health realignment. It often isn't labeled very clearly on the remittance advice, so again, you want to kind of watch for that and make sure that it's getting coded correctly and you're getting credit for that.
No other questions.
Okay. So moving into 2011 realignment, and we talked a little bit about this. So we had additional realignment that occurred in 11-12, dedicated basically sales tax revenues for this specific realigned purpose. And then it basically realigned services previously funded with state general fund monies. And then don't forget that MHSA contributed about 860-something million in 11-12 because there wasn't enough revenue to fund all the realigned programs. So MHSA funds were used to fund the realigned mental health services programs. And so the programs that were realigned, you can see it was all substance use disorder programs that were previously state general fund funded. And it was the Medi-Cal, well, they call it the Medi-Cal Specialty Mental Health Program. And really there were 2 parts to that you received state general fund monies for. One, you received a managed care allocation, And then you also received state general fund for EPSDT services over and above a baseline, and then based on certain share of above growth. So the way the legislation was written for 2011 is that it says that the funds in the behavioral health subaccount must be used to fund these programs that you see here, and it says Medi-Cal Specialty Mental Health Services, which is your entire Medi-Cal Specialty Mental Health program, not just the kids services and not just the fee-for-service Medi-Cal hospital services. And the statute was silent on how much needs to be spent on each program, but it does say that you as the county mental health plan are obligated to fund all Medi-Cal Specialty Mental Health Services with 2011 realignment, 91 realignment, MHSA, and any other local revenues. And then you also have the obligation to fund the drug Medi-Cal program that was previously state general funded and still is to a certain extent on some of the ODS stuff and some of the expansion stuff. So that's what was realigned. In terms of the revenues themselves, they've actually come down a little bit since the January budget, which I think is good. I think it's a little bit more realistic. 18-19 sales tax year to date has been running at about 3.5% above last year, and this 82.6 million for 18-19 is comparable or is based on that 3.5%. The 106 million out in 19-20 shown as growth is based on a 4.4% increase in sales tax, which again I think is fairly realistic. Couple of other things on 2011 realignment. This is a September through August fiscal year on a cash basis, and then also looking at those growth. So the 17-18 growth, I believe we received it in January, and it's good because I think the state and CSAC and CBHDA now have a process where the growth will for sure go out, hopefully within 7 months following the close of the fiscal year. So this 18-19 growth will hopefully receive it, no later than January 2020. And then the 106 million in 19-20 growth would hopefully be received by January 2021. So in terms of looking at what to budget, I think it's pretty much for sure we're going to hit the base, so you can plan on your base amounts. And there was one little tweak that happened to the base allocation percentages. Originally, the first several distributions, I want to say 4 or 5 monthly distributions, used a rolling base concept, but they applied the 17-18 rolling base until they actually distributed the 18-19 growth. Then they knew what each county's 18-19 distribution should be, and they went ahead and made an adjustment. I believe it was with the February distribution to account for the changes in between the 17-18 and 18-19 rolling base. So now these distributions that are coming out are based on an 18-19 rolling base concept. You can see here how to calculate that. Look at 16-17 county allocations were the initial base. Then you take 16-17 growth, add it to that, and then 17-18 growth and add it to that, and that becomes your 18-19 base allocation. But it was a little different this year with the February modification to account for the change. And we did already receive the 17-18 growth, and it's allocated 50% based on approved claims. So basically what you actually spent relative to each other. So it's, again, figuring out how compared to other counties. And then 50% allocated based on the proportion of Medi-Cal beneficiaries in each county. And this was then risk adjusted for the cost of disabled and foster care aid codes. So really trying to get at, this is more of a comparable to a sort of a capitation kind of allocation on this portion, where it's based on where your anticipated need for costs or expenditures would occur. So in budget year, at this point, I'd be looking at keep holding it pretty constant. Potentially, if reflecting the rolling base going into 1920, but until that growth amount is known, it's somewhat speculative, and as well as how that growth gets allocated between all you counties is dependent on, again, what other counties are doing. So if somebody some large county increases their EPSDT expenditures significantly, they could end up with a higher share of the growth than everybody else who just kind of went along and did normal sort of increases. But then once the growth is known this October, I would be looking then at doing a budget adjustment. So that's 2011 realignment. Any questions there?
There's no questions.
All right. So going on to MHSA, this is a millionaire tax, and there's two sources of deposits. One is on a monthly basis. It's 1.76% of all monthly personal income tax payments, which we call the cash transfers. And then there's a settling up between those cash transfers and what is actually earned by the tax based on tax returns, and that's called the annual adjustment. Basically, as funds are deposited at the state level, anything that's unspent and unreserved then gets distributed to you folks at the end of a month, gets distributed to you folks by the 15th of the next month. And so when you have estimated payments or tax return payments coming in, those tend to be the largest collection months. And then by the 15th of the next month is when you see the largest distributions. And then the annual adjustment is also, it has a 2-year lag if you think about it, because tax returns are due, April following the calendar year. A lot of folks file extensions till October. It then takes Franchise Tax Board and Department of Finance from October through basically March to calculate how much was earned, and then that amount is deposited into the Mental Health Services Fund on July 1st, and then so it's then available at the end of July 1st and deposited or distributed to you folks in August. And we saw some interesting things so far this year, which is the purple line, and that pointed this out before, that January was significantly, because in general you can kind of see how things kind of go along, and like I said, the months, so following an estimated tax payment generally jumps up. What was interesting was January was actually lower this year than in any of the prior years, and it had to do mainly with the change in tax laws that capped the amount of state and local tax deductions at $10,000. So there was no incentive to basically pay your state estimated taxes by the end of December to get credit for it in that tax year, and folks basically waited until April when they filed their taxes to actually make these payments. So you see January's low, but then you received a huge distribution recently this month, which reflects the taxes collected in April. And I think, again, it has to do with the change in federal tax policy, just in terms of timing. So here we have the estimated revenues. Looking at current year, the $272 million was deposited back in July 2018, so that is a known number and has been distributed. This $1.7 billion is based on a roughly 6% increase in personal income taxes. It's currently running at about 6.4%, so it's pretty much on track to hit there. For budget year, this $443 million is known. That was published in March, so that is known, and that will be deposited this July and distributed to you folks after accounting for spent and reserved funds. You'll see some of that in August. And then again, the 1920 I think is fairly conservative in terms of it's not a huge projected increase. I think it's about 3 or 4% projected increase in personal income tax payments. This, when we start getting out into 2021, it gets a little bit more speculative. The $632 million is what the state has estimated as the annual adjustment that will be posted in 2021. It is really high. Again, that's based on what we're currently seeing. So that would be based on tax year 2018. So we'll see whether it comes in that high or not. The other thing actually to point out, so the 443 that actually was the calculation was slightly higher than what was in the January budget. So it was about 30 million higher than what was projected in the January budget. And so from that, you can start to look at the component distributions. Like I said, I think we're currently sitting at about 1.6 billion year to date. And again, I'm going off of the State Controller's Office fiscal years, which is in August through July distribution. So we still have 2 more months. Generally, June and July, we see about 300 to 350 million. I'm not sure if the change in federal tax law may impact that. But if we do, we're at 1.6 billion, another 300 to 350 million. So we're sitting around 1.9 to 1.95 billion. And I think that's about where we're going to end up. 1920, is based on those revenue figures. Also, then starts to take into account the No Place Like Home stuff, as well as 2021. So, like I said, the funding for the No Place Like Home debt service has been removed from the component funding. And these are older estimates. I haven't seen any revised figures on what the anticipated amount for budget year and then 2021 look like. But that 62 million assumes that my understanding is that there are going to be some bonds sold this October. The 62 million would be the debt service for about half of those bonds for the rest of the fiscal year. And then, so about $1 billion worth of bonds sold in October. So if that holds true, then the 62 million is a good figure. And then the 88 million is basically a year's worth of debt service on, well, a little bit more. So you'd have a little bit more of the bonds sold sometime in 2021. The maximum that can be used is 140 million for the No Place Like Home when it's fully implemented. But again, given the current interest rates, kind of where they are and how low they are, I would imagine, the sooner that they actually issue these bonds, the 130 million that was actually in the ballot initiative probably is going to turn out to be a more accurate estimate than the 140 million. And you can figure out how much your share is by figuring out your share of what percent your allocations are of the statewide MHSA allocations, multiply it by 130 million, and that will be funded for 30 years to pay off the bonds. And so again, what we're looking at is continued growth in funding. We have a decrease in the current year, but then I think because of the larger annual adjustments over the next couple of years, we'll see growth. But the one thing, there's a couple of potential issues that would lower the amount that you see in the prior chart in this chart. And so I would look even at budget year and definitely 2021. These are kind of maximum amounts because this whole workforce education and training 5-year plan There's a couple of things going on to fund that. One that did come out in the May revise is the governor wants to take $37.5 million out of the Mental Health Services Fund and use it to help fund this this plan. So that would probably be a reduction of $37.5 million to this amount. It's one time, and it covers. It can be used over 5 years, just like the plan. But then there's also another proposal, SB 539, that also would redirect MHSA funding to fund this workforce education and training 5-year plan. And based on these revenues, I'm estimating somewhere around 40 to 45 million in 1920, and then another 75 to 80 million in 2021. So kind of the bottom line is that if these go forward and if they're enacted, I would envision these being reduced by somewhere around $80 million in terms of the actual distributions. But then on the plus side, there's supposed to be these reverted funds, and those should be redistributed, which may actually increase how much funding you get. But what I would look at, so for current year, I still think a 5% decrease compared to last year. And you can look at your individual county percentages that are shown in that info notice. Although the actual allocations in that info notice, I think, are a little low, but you can take a look at that and kind of ballpark where it looks like you'll end up. And then for budget year, I say a 5 to 10% increase. I'd be conservative and just go with a 5% at this point, given what what it's looking like with this workforce education and training stuff, rather than a 10% increase. So I'd probably go more on the conservative side. And again, then even going out an additional year, you're probably looking at another 2 to 5% above the 1920 amount, at least at this point, if you were trying to forecast 2021. So that's MHSA. Any questions there?
Just one question. For the annual adjustment that is known in March, where is this published?
So it's not really published. There's a letter that goes from, I believe it's Department of Finance, to the legislature. I think it goes to the legislature, maybe it goes to the state controller's office. But CBHDA distributes that, and we can email out a copy of that with the MOE after this call, just so that you have a copy of it if you're looking for support for that number. All right, going into the Medi-Cal, especially mental health reimbursement. As you're aware, you're reimbursed based on your certified public expenditures, and then there's different reimbursement percentages depending on how the beneficiary qualified for Medi-Cal. And that's generally how it works for all Medi-Cal, especially mental health services. The one exception are the fee-for-service Medi-Cal inpatient hospital services, where the hospital invoices DHCS, gets paid by DHCS, and that's where you see as the managed care offset to your 1991 realignment. You're reimbursed based on an interim rates and interim amounts throughout the fiscal year as your services that are Medi-Cal eligible get approved, and based on interim billing rates by service function codes and for different legal entities. And in general, you want to have the interim rates for your contract providers are supposed to equal the amount that you pay them, while county operated providers, the goal is to try to approximate what you think your actual costs are going to be. And the state does set maximum interim rates for county operated providers based on your most recent filed cost report. And then you have this reconciliation that occurs between the interim amounts and what you show on your cost report, and then you get audited to determine the final Medi-Cal entitlement. And as I'm sure all you're aware of, DHCS has been expediting. They've fallen way behind on both, well, primarily on the settlement process, which then has forced the audit process to lag. And so they issued an information notice where they're supposed to speed up these timelines. Although, to be honest with you, some of the counties I work with, they're falling behind. The state is falling behind on those timelines. They were supposed to already have settled all the way through 12-13 back in January. And then by the end of next month, they're supposed to have 13-14 and 14-15 settled with each of you. And then the goal is to have 15-16 and 16-17 settled by the end of this calendar year. And then fiscal year 17-18 settled by February 2020, which is then back on a normal cycle. And then once they do that, then the state has 3 years to audit. And to be honest with you, the way, which would mean it would all fall basically in calendar year 2022, they would need to have most of these audits done. But the way I would, if they stayed on the settlement timeline, I would think they'd be looking at trying to have 12-13 all the way audited by the end of this year, calendar year. They try to do 13-14 and 14-15 next year, 15-16 and 16-17 in 2021, and then 17-18 would be done in 2022. But again, if they don't catch up on the settlement process, then we're still going to lag, and it's who knows when they'll get to the audit. In terms of what was included in the May revise for FFP, for Medi-Cal, especially mental health services, you can see the amounts here. Actually, it was interesting. They're depicting a decrease in FFP with existing mental health services, although pretty slight. But it was surprising to see that they think it's actually going to go down over 17-18. And then we have this supplemental state plan amendment, which hopefully you all completed the next round of claim submissions to request funding, and that's what the state has put in budget year, about $114 million of FFP that they anticipate paying out based on the claims that you folks submitted. The one thing this doesn't include would be the proposal to cover undocumented age 19 to 25 individuals with basically a state general funded Medi-Cal type of benefit similar to the SB 75. So that is not included here, and I believe that's about $250 million or so that in additional funding that would go for especially mental health services. So any questions on the FFP or the Medi-Cal program?
There's no questions.
All right, then there's a bunch of these little pots of money for different statewide state general fund initiatives. And this all, most of this stems from the Prop 30 requirement that was part of the 2011 realignment, that any additional requirements placed on counties that the state would share in the burden of the match funds for that. So you've got a little bit of money for continuum of care reform, and this is to participate in the client family teams and placement assessments and training. You have the EPSDT performance outcome system, and again, that is the cost to train, administer, implement, and complete the CANS assessment tool for the kids services. There's managed care regulations implementation. Again, a little bit of money there. This is your network adequacy, monitoring, one-time IT type costs. Then you got mental health parity, which is for some of the pre-authorizations and reviews. But really where most of the funding has to do with the increased state share for the Affordable Care Act Medi-Cal clients. If you remember when this was implemented, back in 2014, California chose to include the optional Medi-Cal population, which were funded at 100% federal funds initially. They're now, so in 2018, they were funded at 94% federal funds, 2019, 93% federal funds, in 2020, 90% federal funds. But fortunately, the state said they're going to make up the difference and basically continue to fund you. From your perspective, you're getting 100% funding for these services. And so you see 50 million in current year and 73 million in budget year for state general fund reimbursements for those services. And then the one thing that they started including in the budget this year was the amount of state general fund for these SB 75 children. You know, again, full scope undocumented children. And you can see the budget amounts there that they're projecting in state general fund monies. Then you also have additional utilization review cost for certifying the foster family agencies, and then for you dealing with the special terms and conditions around data collection. There's one-time funding for this homeless and mental illness program, and then the repayment of the AB 3632 mandate. So again, a lot of little pots of money, still yet to be seen how, like the performance outcome systems. I know CBHDA had recommended a certain distribution approach, and I'm not sure where that is. But the one thing, again, on any state general fund money to keep in mind, if those of you who remember the early days of EPSDT, anytime there's state general fund monies, the auditors really scrutinize it. So to the extent you're drawing down state general funds, make sure you've got the support and meet the requirements for drawing down the state general funds. Any questions there?
There's one question. Can you provide some information on how the ODS waiver is going as far as funding to county?
Yeah, I honestly have no idea. I haven't been following the ODS waiver, but I believe Paula will be talking about that next week at the Fiscal Leadership Institute and can give you guys an update.
Yeah, that's right. Another question, is there an estimated amount for fiscal year 1920 EPSDT performance outcome system?
Yeah, so this morning when I was going through the presentation, I realized I did not put 6.8 million in there. So the slide here is correct. The slide that you have is not. It should say 6.8 million for 1920 right there. And again, that's for the CANS implementation and all the costs associated with that. Again, CBHCA has made a recommendation, I believe, on how to distribute those funds, but I'm not sure DHCS has responded. All right, then just kind of putting it all together, you can see here this year is actually ending up being kind of a flat year, not much growth, predominantly because you had, what, 100 million decrease in MHSA, and no growth really on the 91 side, and just a little bit in the 2011. So not much growth this year, but we do expect more growth next year as the economy continues to go along. And the interesting thing, I mean, going back to the 91, basically the new governor is doing what the old governor could have done when they decided to discontinue the Coordinated Care Initiative. They could have put excess state general fund monies into this program, so we could have had some growth, but unfortunately he didn't. And so we're kind of stuck where this has been relatively flat over the last couple of years. And then lastly, just where I get a lot of my information, you can kind of hear and click at these different resources to take a look at, to track revenues, just kind of stay up to date with what's going on. One other thing, there's not a whole lot, I don't think, going on, at least on the mental health side right now. But the one thing, just to make sure it's still on your guys' radar, that MHSA calculation of prudent reserve, those are due at the end of next month to DHCS and the OAC. So make sure you get the calculations done, showing July 2013 through June 2018, your MHSA distributions and how you go through the calculations, and it's all outlined in Info Notice 19-017. But make sure you get that done. It doesn't need to be posted, but make sure you get that done and submitted by the end of June. So that was it. Any other questions that are mental health and not SUD related?
No more questions.
Okay, great. Then we'll go ahead. I will email to Shoshana the 1991 Realignment MOE document and the annual adjustment, and she will get that out to you folks. And hopefully we'll see most of you at the Fiscal Leadership Institute next week.
All right. Thanks, everyone. Hope to see you next week.
Bye-bye.
Bye.